Welcome to Banking 101, a first principle jargon-free course on banking. In lessons 1 and 2 we developed an understanding of the financial services industry and banks. But we often hear the term capital markets. In this lesson, we will learn more about capital markets. So let's get going. Capital markets are a subset of financial markets. Financial markets are categorized into money markets and capital markets. The term money markets refers to the market for short-term borrowings, the duration of which can range from 1 day to 1 year. An example is the market for treasury bills, by which the U.S. government borrows for a duration of less than a year. While money markets are important, their size is dwarfed by capital markets. In the United States, the share of money market in total financial markets is less than 5%. Hence, this lesson will focus on capital markets, though many concepts covered also apply to money markets. When we think of markets, we may think of a physical space like a mall or an online marketplace like Amazon. But it is useful to think of capital markets in a more abstract sense. If a transaction meets certain criteria, it is said to occur in capital markets regardless of the physical or digital venue it is occurring. An analogy with the used car market is helpful here. You can buy a used car in many ways. You can go to the seller's house, pay and drive away with the car. Alternately, you could buy from a used car dealer or from an online seller. We will call all these transactions as having occurred in the used car market. The used car market is thus a conceptual aggregation of transactions of a specific type, in this case, the sale of a used car. In this lesson, we will define what type of transactions would be conceptually aggregated to constitute capital markets. Consider a bank that engages in a series of transactions. It issues credit cards, makes home loans and car loans to consumers, and makes loans to businesses. None of these transactions are said to occur in capital markets. Consider the following transactions. A company raises funds through an IPO. A venture capital firm invests in equity of a startup. A private equity company makes a loan to a business. A bank buys foreign exchange on behalf of a corporate client who needs to pay a supplier in another currency. All these transactions are said to occur in capital markets. Given the diversity of these transactions, it is hard to find a common thread that defines capital markets. Yet this is precisely what we will do in this lesson. Just like the used car market is a conceptual aggregation of used car sales, capital markets is a conceptual aggregation of transactions that meet at least one of two criteria. First, the expressed form of financial asset being sold is fungible. The second characteristic that would qualify the transaction as a capital markets transaction is if it is channeling capital from savers to users of capital in a structurally disintermediated way. We will deep dive on the criteria of fungibility first. In our definition of capital markets, we use the term, expressed form of a financial asset. Let us revisit this concept that we learnt in Lesson 1. The major financial asset categories are currency, equity, debt, derivatives and crypto assets. But there are many forms in which these financial assets are actually expressed. The expressed form of financial asset is considered fungible if two conditions are true. First, there are multiple units that are interchangeable, either one-to-one or in combinations. Second, each unit of the financial asset has a defined price at which reasonably large quantities can be bought and sold. Let us explore further. It is easier to understand fungibility in the context of physical assets. Consider gold. After it is mined, it is molded into bars, coins and ingots. These forms are fungible because the units are homogeneous. To the extent one gold bar is heavier than the other, you can perform an equivalent exchange. The market price of an ounce of gold can be easily obtained from a commodity exchange. But gold jewelry is not fungible. Each piece is fairly unique and there is no defined unit price at which a large number of gold necklaces are traded. Fungibility is a continuum instead of a binary. On one extreme are fungible physical assets like commodities and on the other extreme are non-fungible objects like Renaissance art. We could put used cars somewhere on the left side of the continuum and real estate on the right, though opinions may differ on how far left and right. Let us review 3 common examples where the expressed form of financial asset is fungible, namely common shares, bonds and fiat currency. Common shares are simply units of ownership in a company. Shares of a company listed in a stock exchange is fungible. Every share of Apple is the same. Some companies have Class A and Class B shares, but within each class, they are identical. Shares of a company not listed in a stock exchange, say that of a startup, is no different. There are multiple units of shares which are identical. Further, every share has a price, which is explicitly articulated when ownership changes hands, whether on a stock exchange or a privately negotiated sale. Bonds are instruments issued by companies and governments to borrow money. A bond has a face value that gets repaid on maturity. The face value is the principal. The rate of interest is known as the coupon and is usually fixed. While the principal is repaid on maturity date, interest is usually paid quarterly. A company can issue 1 million bonds with the same face value, coupon and maturity date as part of a capital raise on an issue date. All bonds issued as part of a single capital raise are fungible as they are interchangeable. The price of a bond is expressed as a percentage of the face value. A price of 100% means that you have to pay the face value. Currency is another example of a fungible asset form. Every $10 bill is the same. While $10 bills are different from $5 bills, 2 $5 bills are the same as one $10 bill. Further, every unit of currency has a clearly expressed price. If quoting the price in the same currency, then the price of the currency is its face value. If quoting the price in an alternate currency, it is the exchange rate. We define fungibility as the existence of multiple units that are interchangeable with a defined per unit price. But how do we define one unit of a financial asset? We can think of a unit of a financial asset to be defined by its attributes. Consider equity. One unit of equity, namely one share, can be defined by a few attributes. One attribute is the name of the company that issued the share. Another attribute is whether it is common, preferred or restricted. Another attribute is whether it is Class A or Class B, which differ in terms of the voting rights they confer. Any one unit of equity that has the same values for the three attributes is indistinguishable from another. The attributes that define a unit of a financial asset can be compared to the attributes that define the variance of the model of a car. We can think of the car brand as the parent asset and the model as the expressed form. Consider another financial asset, fiat currency. What attributes would constitute one homogeneous unit? The answer is simple. We only need to know the name of the issuing country or supranational entity in case of the euro. The price of the unit is simply 1 if we are quoting the price per unit in the same currency. A $5 note is essentially 5 units as per our definition of a homogeneous unit. If we were quoting the price in a different currency, the price would be the exchange rate. We will now look at a more complex asset. The example we will take is that of a call option contract, which gives the option buyer the right, though not a compulsion, to buy shares of a company at a defined price before a specified date. A typical call options contract has 4 attributes. First, the company whose shares the options are linked to. Second, the number of shares you can buy. Usually, one options contract incorporates the right to buy 100 shares. The third attribute is the strike price. Say the current share price of the target company is 70. You buy a call option that gives you the right to buy the share at 75. The fourth attribute is the expiration date of the contract by which you must exercise this right to buy. Assume the expiration date is 2 months from the date the contract was signed. These 4 attributes represent one options contract. Any options contract with the same attributes is interchangeable. The price at which you buy this contract is called the premium. Assume that to buy this call option you need to pay a premium of $5 per share. Hence, for one options contract, you pay $500 since one options contract included 100 underlying shares. Effectively, this means that if the price of the share remained below 80 before the expiration date, you would not make any money. But if the price went above 80, you could exercise your right to buy the share at 75 and make a profit. The point here is not to go deep into derivatives but to understand the definition of a fungible unit. We define fungibility as the existence of multiple units that are interchangeable and have a unit price. When in doubt, we can ask a smell test question. If you were considering investing in multiple units of the financial asset, would you evaluate each unit separately? If you are buying 100 Apple shares, are you making one decision or 100 decisions? The answer, of course, is that you are making one decision. Let us apply the same smell test to Bitcoin. If you decide to buy 10 Bitcoins, you are not making 10 decisions. A random fun fact. The smallest unit of a Bitcoin you can buy is a Satoshi. 1 Bitcoin is equal to 100 million Satoshis. Consider this scenario. A lender makes 2 car loans to John for $30,000 each. One is for an electric car for city use. The second one is an SUV that John uses for weekend road trips. Are the 2 car loans fungible? Let us apply our definition of fungibility. Are the 2 loans interchangeable? While these 2 loans are equal in amount, they are not identical. Perhaps John made a bigger down payment on the electric car and hence, is less likely to default on the electric car. The interest rates may not be the same. The 2 car loans are not interchangeable in the same way as 2 Apple shares. Is there a defined unit price? The lender now agrees to sell the loans to you. From the date you buy the loan, you will be entitled to receive all principal and interest payments. You may think John is less likely to default on the electric car, so you are willing to pay higher for that loan. However, is no defined unit price that says you should pay 102% of face value for all electric car loans made to prime borrowers. Now, let us apply our smell test. If you were buying the two loans from the lender, are you making one decision or two? You are making two decisions. We can conclude that the car loan is not fungible. There is a process of financial engineering called securitization by which these loans can be transformed to a fungible form. But the individual car loan is not. Consider a lender who makes two loans to the Boeing company. One loan is for capital expenditures. The second loan is for operational expenses. Are the two loans made to Boeing fungible in the same way that two shares or bonds issued by Boeing would be? Let us apply our definition of fungibility. Are the two loans interchangeable? Even if these two loans were equal in amount, they are not interchangeable. Each of these loans has been negotiated with terms that are specific to the loan. Is there a defined unit price at which you buy these loans? From the date you buy the loan, you will be entitled to receive all principal and interest payments. What is the price you will pay? There is no defined unit price for such loans. We cannot say that all loans to aircraft manufacturers can be bought at 95% of their face value. Finally, let us apply the smell test. If you were buying the two loans from the lender, are you making one decision or two? You are making two decisions as you will be evaluating the terms of each loan separately. Some loan contracts have terms that would allow the loan made to Boeing to be parceled into smaller slices, which can be bought by multiple lenders. This is called loan syndication, and the individual slices of the loans can be fungible. However, the parent loan to Boeing is not fungible. Just as in physical assets, fungibility of financial assets is a continuum. Shares are very fungible. Bonds are fungible but less so. Bond units issued by a company at different times have different terms associated with them and are less interchangeable than shares issued at different times. The point at which a financial asset becomes a capital markets-oriented fungible asset is not always a bright line. To recap, we said that if the expressed form of financial asset being traded is in a fungible form, the transaction qualifies to have occurred in capital markets. We also defined what fungibility means. 90% of capital markets transactions meets the first criteria. However, a small but growing corner of capital markets only meets the second criteria. The second criteria that would qualify a transaction as a capital markets transaction is, if the transaction channels capital from savers to users of capital in a structurally disintermediated way. We will now explore this concept further. To understand the second criteria, we need to understand capital allocation. Capital allocation is the process by which capital is mobilized from savers and then deployed to individuals and businesses in the form of equity or debt. There are two methods by which capital is allocated in an economy: the intermediated model and the disintermediated model. Understanding the distinction between the two is critical to understanding capital markets. Let us look at an illustration of intermediated capital allocation. Lily, Andrew, and Mary, who have surplus cash, would like to earn interest on this surplus. Meanwhile, bouquet flowers and stainless cleaners are businesses need capital to expand. The deployment of capital from Lily, Andrew, and Mary to the businesses is a fairly complex problem. Let us begin with the savers. First, the savers may not even know that the businesses exist and are in need of funds. Second, they may not have the time or the skill to gauge the risk of the businesses. Let us look at the problem of the businesses. First, the businesses may not know who the savers are. Second, the search costs of finding willing lenders are too high. To solve this problem, a bank comes into the picture. The savers deposit their savings in the bank. The businesses apply for a loan with the bank. The bank analyzes the finances of the businesses, and either approves or declines the loan request. In an intermediated model, the ultimate sources of capital do not have a direct claim on the end users of capital. There are two obligations in our scenario. First, the bank has an obligation to repay its depositors if they wish to redeem their deposits. Second, the borrowers have an obligation to repay the loan principal, along with interest, to the bank in accordance with the agreed-upon loan terms. In the disintermediated model of capital allocation, ultimate providers of capital have a direct claim on the entity they are funding. Consider an IPO. A company raises funds in an IPO from investors. The investors are paying for an ownership share in the company, to whose prospects they will have direct risk exposure. Another example is that of a small business that raises funds through a crowdfunding campaign. In an IPO, an investment bank plays a lead role in connecting the capital issuing entity to prospective investors. The use of the word disintermediation seems to suggest there is no middleman. However, that is certainly not the case in our IPO example. This apparent contradiction can be resolved by noting that we are talking of disintermediation of risk, not disintermediation of the operational process by which capital is allocated. Consider a hypothetical private equity transaction. In our illustration, the PE firm raises funds from endowments of universities. It then creates a fund. Think of a fund as a legally constructed entity similar to any other company, except that it was created to pool capital of multiple investors. The fund starts investing in companies. The investors in the fund, called limited partners, or LPs, dictate broad investment criteria. But the investment decisions are made by a general partner, or GP, who represents the private equity firm. GPs may also invest some of their own money into the fund to prove that they have skin in the game. The PE fund could either invest as an equity investor in the target company or make a loan to the company. If the PE fund invests in equity, the transaction would be considered a capital markets transaction by both of our criteria. However, if the PE fund makes a loan to the company, we would still call it a capital markets transaction, even though we know business loans are not fungible. We can now see the distinction between the intermediated and disintermediated model of capital allocation. In the intermediated bank transaction, the capital allocator is the bank, which raises deposits and is obligated to repay the depositors. The bank then lends to businesses, who are obligated to repay the bank. In the disintermediated PE example, the private equity firm is the capital allocator. Like a bank, the PE performs due diligence on the target companies, but the investors are directly invested in the target business, through a fund that pools their capital contributions. The Venn diagram on this page shows us the commonality and difference between intermediated and disintermediated capital allocation. The commonality lies in the fact that savings are being mobilized for the purpose of deployment. The difference lies on who bears the risk. In any discussion on capital markets, we will repeatedly encounter the term funds. Mutual funds, private equity funds, venture capital funds are all examples. Hence, let us take a minute to understand what funds are. To understand funds, we need to understand legal entities. Legal entities are entities that are using a legally authorized format to engage in some type of economic activity. An example is a corporation. Natural-born entities are simply people. Government entities are ministries, agencies, and republics. Legal entities are created through legislation. Examples of legal entity types in the United States include sole proprietorships, partnerships, limited liability companies, and corporations. Every country has similar designations governed by local laws. Legal entities can be operating entities with real-world operations like a car manufacturer or an insurance company. Asset holding entities, on the other hand, exist only on paper, for the purpose of holding assets. Funds and trust accounts are examples. Funds are asset holding entities that pool the investments of multiple individuals and other legal entities for the purpose of making investments. Some funds, like mutual funds, are open to the general public. Other funds, like venture capital, private equity, and hedge funds, mostly raise capital from institutional investors like insurance companies, pension funds, university endowments, and sovereign wealth funds. Consider a venture capital firm. This is an operating entity consisting of partners who evaluate business ideas from startup founders who pitch them. The venture capital firm creates multiple funds. The funds are similar to the VC firm in that they are also legal entities. However, they don't have real-world operations. Their sole role is to hold investments in each fund specialized in an industry. Each of these funds could have different investors. The venture capital firm is organized, in our example, as a limited liability company, popularly abbreviated as LLC. The fund legal entities, in our example, are organized as limited partnerships, an alternative entity type to LLC. To conclude this discussion, when we use terms like private equity, venture capital, or hedge funds, we could be talking about the operating entity or the fund, depending on the context. Let us now do one final recap of the definition of capital markets. Just like the used car market is a conceptual aggregation of used car sales, capital markets is a conceptual aggregation of transactions that meet at least one of two criteria. First, the expressed form of financial asset that is being traded is fungible. The second characteristic that would qualify the transaction as a capital markets transaction is if the transaction is channeling capital from savers to users of capital in a structurally disintermediated way. Let us look at some capital markets transactions and assess them against the two criteria. A business raising equity meets both criteria. All expressed forms of equity are fungible. At the same time, a business usually raises fresh funds from investors during an IPO. When a venture capital invests in the equity of a pre-IPO company, the transaction again meets both of our criteria. When we buy shares of Apple from our online brokerage account, it meets the first criteria. Since we are buying and selling existing shares, no new capital is being channeled to the company. Hence, the second criteria is not met. But as long as one of the two criteria is met, we would still classify this as a capital markets transaction. A bank buying foreign exchange for its corporate client meets the first criteria since currency is a fungible asset. A private equity firm making a loan to a business does not meet the first criteria since a business loan is not a fungible asset form. However, this is still a capital markets transaction since the second criteria is met. This form of lending is also called direct lending to convey the idea that investors have direct exposure to the credit risk of the loan recipient. Another example of a transaction involving a non-fungible asset is a PE firm buying real estate. The investors, whose money the PE firms are deploying, are getting rental income in return for their investment. We can categorize the various expressed forms of financial assets into the binary categories of non-market and capital markets-oriented forms. The non-market-oriented forms of financial assets are on the less fungible side of the continuum, while market-oriented forms are on the more fungible side. The financial assets transacted in capital markets can be grouped into three broad categories. In the first category are capital allocation vehicles. The second category is currency. The third category are derivatives, which are used to manage risk, and can be classified further based on the underlying risk they mitigate. When we look at this list, only two categories, shaded in blue, namely direct lending and real assets, are non-fungible. As regulations made banks more risk-averse, businesses increased their reliance on capital markets and hence, these categories grew. However, more than 90% of transactions in capital markets relates to fungible financial assets. Hence, fungibility is the hallmark of capital markets. Just because one room in our house is our home office, does not make our home a commercial property. This brings us to the close of this lesson. In the next lesson, we will conclude our discussion of capital markets. Please review the summing up section of this lesson. I will see you soon.